Hey, it's Jonathan. Thanks for joining me today. I hope this video finds you in good fortune. Uh, this video kind of started out as a thought experiment, and the idea is always you want to buy at the bottom, you want to sell at the top, and I like to kind of visualize where I'm at in the market, whether I'm at the bottom or at the top, compared to previous data, previous price history, right? So I was looking at the interest rating, and we're at the bottom, and I haven't heard anybody say that it's even possible that we're going to go back up to 15, 18%. In fact, everybody that I've heard has said quite the contrary. No, it's not possible. Everything will break if we go to 15, 18%. Um, but could we go to 15, 18%? Could we go higher? Could we go to 25%? This is kind of a thought experiment, and I was trying to find data to support each point of view, and this is what I came across. You might be interested. Is it really possible if we could go to 25% interest rates? Are the cards lining up that it might make it possible? And I found a couple interesting things. So let's walk through this. Look, I'm by no means a financial expert. I record these videos because I like to go back and review what I'm thinking. I do this for personal growth, really, and I thought you might like to come along for the ride. So I post the videos, and sometimes I'm right, sometimes I'm wrong. But anyway, so here we go. Let's just consider this for a moment. Let's see here. Let's go to the Fred website. This is the effective rate. This is our interest rate here. So right now we're at 3.08% interest. If you look back here in the 80s, we were up at 22% was the top, right? We hit 19%. Even in 1986, we were at, let's see what that is. That's 13%. More recent history, it's 2007. We were at 5%. Is it possible that we, we're just right here in the beginning, right? This was right around 4%. This we're in the 60s. Is it possible that we're kind of back here at the beginning, and we could even get here? Now, everybody's argument against this is, oh, everybody's in debt. And this is true. This is true. So when the interest rates goes up, but what if allowances were being created where it was what if maybe the government did something good, right? And there was allowances being created for people that actually did not put themselves in debt to obtain wealth, and then maybe put the people that are real risky and high risk assets, they're just going to go bust. Let's just think about this. So, what would happen if the interest rates would go back up here to 22%, right? Or even 25%? What would happen if the interest rates would go to 25%? For one, the government would be upside down because the government is, a terrible manager of money. Okay, so first of all, the government's not going to want to put themselves upside down. They would start making allowances for themselves for them to weather the storm, right? Now, a great percentage of the GDP from Americas, I mean, we are a consumer nation. It's from us consuming, right? So you'd want to protect a portion of the population as well from a 22% interest rate hike. 25% interest rate hike. You would want to protect them as well. You'd want to find the people that were not in debt, and the people, and a new source of people you could lend credit to. These are the things that you would want to. The government's going to want to protect themselves, and the government's going to want to protect some base of consumer and allow them to maybe untap purchasing power, right? So if we're right here at 4%, and we may go back up to 22, up to say 25%, this may not even be possible. You might, like, if you know more than if you know some reason that this is absolutely 100% not possible, please leave it in the comments. I love to learn myself. And like I said, this is a thought experiment. I've tried to think this out and tried to think reasons why this couldn't happen, and I haven't found any reason why this actually couldn't happen. The only excuse I find is that, oh, everything will break, everything will blow up, um, and it would be a rough time. But so we're here at 4%. I found this article um, that came out. The first one, Janet Yellen here, she's been talking about. She's a Secretary of Treasury, right? She's a Treasury Secretary, and she's been talking about this buyback program in the treasuries. Okay, and what she's saying is she's saying that the long-term treasuries are not, there's not enough liquidity. So initially, what they're talking about now is selling short-term treasuries and then buying back long-term treasuries, so there'll be more liquidity in the market. Okay, so what would happen when this happens? If you don't know what a treasury is, a treasury is basically government debt. You buy that, they give you when you buy a treasury, then you're basically loaning the government money, and they're going to pay you an interest rate on that. All right. So what happens if the government gets into the treasury purchasing business? What would actually happen? They'd be buying their own debt and then paying themselves back the interest rate. Okay. Um, so what would happen? What would, that would be a motivating factor, possibly to raise interest rates to a very high point before plummeting them. Okay, you know, this could potentially, and I'm not saying, this is just speculation, but I'm thinking about this, right? This is a thought experiment. Potentially, the government, if they jacked interest rates up, if they approved this plan where they could buy back their own debt, right? Whether they're doing it through selling short terms and buying long terms, then they and interest rates went back up to 20-25%. They could buy a bunch of the debt. The money would be, they would own their own debt, the government's own debt, and the interest payments would be going back to the government, or however they structure that, right? But that doesn't leave any room in that. That would actually prop up the government, right? But that doesn't leave any room for the consumer. Incidentally, this would also create um, a very distinguishable time cycle in the government, because as those treasuries would start to mature, they would want to sell those off, and they would want to push the interest rates, excuse me, right back down. Okay, so this could potentially create a 20-year. They're talking about 20 years. She's talking about 20-year treasuries right now. This could incidentally probably create a 20-year cycle, a 30-year cycle, depending on the length of treasuries. Something that could, if I start to see this play out, then these are the things that I'm going to be watching, and this will create a 20-year cycle for me, or a 30-year cycle, depending on what they're purchasing. Uh, when I make these videos, even if it doesn't play out like this, it gives me something to reference off of, right? And my thoughts to see how it's playing out, if any part of it is playing out. So this would and I'll let you research this. All you have to do is basically search for the Secretary of Treasury's Janet Yellen, and the buyback program. But that's basically what she's proposing, is the government buying back their own treasuries, and it would make sense to jack up, if they were approved to buy back their own treasuries. It would make sense to run the interest rates up as high as they could. So okay, now the consumer base, you got to protect that consumer base. Well, I was reading this article. It's the Federal Housing Finance Agency approves 2 new credit scoring models. Okay, so we have the FICO score, and the FICO score, what it does is it approves you on things like how many lines of credit you have available to you, how much credit you have available to you, how much of that credit you're actually using. So it approves you on these things, right? And this is, if you have 30 credit cards and each of them have 50 grand worth of credit on it, then and you're only using 10 grand, then this makes your score high. I'll let you search how the FICO score works, but this is basically, do you make your payments on time, how much credit you have available to you, and how much of that available credit are you using at any given time. The Vantage score, they have this new, so they're changing the FICO score a little bit. So we got your FICO 10T, and then you have your Vantage score 4.10. And what they're proposing to do is they're proposing to um, make it so that they take into account things like how much money you have saved in your bank, which is not considered. If you're a renter, uh, do you pay your rent on time? Even small things like your phone bill. Do you have a phone? What's your phone bill history? What's your credit history basically with your phone bill? Do you pay your phone bill on time? Do you pay your rent on time? Do you pay your utilities on time? These are things that they're wanting to start to consider. And what this would do is this would open up lines of credit um, to basic. I think the figure was like 35% of people don't. 35% of Americans don't. It might have been in a different article. You can look that up. But I think it's like 35% of Americans don't have good credit that would have good credit because they pay their bills on time, they have money in the bank, they pay their phone bills, they pay their utility bills, but they just haven't built their credit yet. So this would open up credit to a whole new sector of the population by having by changing the algorithm of how credit is calculated. This would also encourage people to save money. If they're looking at the amount of money in your bank account, then this would encourage people to save money. This is really, in my opinion, what is broke with the system. Now, I mean, ultimately, what's broke with the system is that people can just print money and, they can print money and give it away. The government can print money and give it away. And, but even with that, even with that consideration, if you encourage saving, if you promote financial stability, saving, and things like that, then which a high interest rate definitely promotes saving, right? This is just a fact. Um, then this would if you promote things like saving, then people are going to save, and this would definitely promote saving. If the people that actually save money, as opposed to the people that spent a lot of money, had good credit, um, then this would not destroy a 20% interest rate would not destroy a consumer base that that wasn't in debt, right? This would actually kind of change the economy. At the same time, things I'm looking into now that I'm talking this out, things I'd be looking into too is manufacturing coming back to America. Are there things being promoted to promote manufacturing? You would probably want a manufacturing arm to come back in this. So this is news that I'm looking for quite possibly in the future to support this speculation. We know things can't stay like they are, and things are going to change, but history does rhyme with itself, right? And just what if we are right around here, and this is where we're going ultimately? It's just a thought. Look, if you like to buy low and sell high, give me a like, subscribe. I appreciate you watching the video to the end. Comment on the video. Tell me where I'm wrong. Tell me where I'm right. So we can learn together. And make sure you check out our blockchain friends. And all that stuff. You are beautiful, and I will see you next time.